Welcome to the next session of financial forensics, and then we are still focusing on the basics of financial accounting. In the last class, what we did was we focused on the preparing the balance sheet. This is what we prepared. The balance sheet of a cafe, that is, we prepared the balance sheet of the cafe as of two dates, different dates, that is when the cafe opened and when the cafe closed down. So what did we prepare? We prepared the statement of what is owned by the cafe and what is owed by the cafe on each of these specified dates. And we said that we arrived at a loss, and we talked about utilization of the sources of funds and the utilization of the source of funds out. I said that if you make a efficient utilization of the sources of funds, you generate more value. I use an example also. If you make an inefficient utilization, you end up making a loss, and that is what we saw. That is, you had a source of fund of X, you have utilized it in such a way that the value of it is less than X, then the difference between the two is nothing but the loss, which is again borne by the capital providers. So, loss is of the firm. Why is it the capital provider? Agreed. Loss is by the firm. But somebody has contributed the capital to the firm. Why have they contributed capital? They have contributed capital so that they will earn more money. When they do not earn that money, then obviously it is a loss. That also will have to be borne by only the guys who provide capital. Suppose in the same example, the entire capital is eroded. The entire capital, that is, instead of $10,854 loss, the loss itself is equal to 32 plus 16, that is about the entire loss itself is about 48,000 totally. Then what happens? The capital is zero, the capital ceases to exist. Where the capital contributed by the two partners is 32 plus 16, 16 into 3, 48,000. If the loss itself is 48,000, then what is the net worth? Blob, zero. So what happens? The loss is basically, then the firm, after paying off, that is, after selling off all the assets out here, I will generate this money. I use it for paying the liabilities, then I have nothing basically left in the process out there, and to pay for the capital provider. Now, having said this, I am going to talk about a couple of more aspects out there. I am very sure I didn't, we will sort of look at that basic aspects out there. We said, what is that capital? Normally when we say capital, when we talk about what do you call it as, when we talk about what is called as capital, we talk about two different kinds out there. One is what we call it as equity capital, another is what is called as a debt capital. Debt is nothing but a simple what is called as a borrowing. It can be from multiple sources. It can be, you can borrow from a bank, yes. I can borrow from a financial institution, yes. I can borrow from a foreign bank, yes. I can borrow from a foreign financial institution, yes. I can borrow from the public in the form of debentures, yes, and so on and so forth. Whereas when I am talking about equity, and all these borrowings will normally attract a percentage of interest. Sir, is it fixed interest, floating interest, etc., all that depends on the agreement when you basically float the debt instrument out there. So let us not even get. These guys who have provided debt will have what do you call it as no decision making right in the company. These guys who provide what you call a debt will have no decision. That means no voting right. They don't decide the fate of the company. The equity providers are nothing but the owners of the company. The equity providers decide, they have what is called as voting right. They decide the future of the company. They make decisions with regard to the company. They are the owners of the entity. Now, sir, how do you say owner? Do you mean to say I am a owner of this company? That means I have shares, equity shares in this X company. Do you think I am a owner of the company? Yes, you are an owner to the extent of your investment. Supposing I say my company, a company, let us say a company X has a share capital of 10 lakh shares at $10 each. That means what is the total value? Total value is 1 crore. Now, you own 10 shares. You own 10 shares in this particular company. Then what is your ownership? Your ownership will basically be, what is it? What is your ownership? Your ownership will be equal to what is called as, your ownership will be equal to 10 divided by, your ownership will be equal to 10 divided by 10 lakh shares out there. Express it in the form of percentage. You can express it in the form of percentage. What is the percentage? So, your ownership will be equal to 0.001 percentage out there. So, what happened? Your ownership is only so much, 0.001%. So, having 0.001%, then you will obviously not have any controlling right out there. You will be a owner to the extent of what? 0.001%. Then who sits and makes decisions? Who sits and controls? Majority stakeholder basically makes the decision, and though you will have, being a 0.001% shareholder, you will still have what is called as voting right in the entry. You can still decide the votes of the company. I mean, you can still vote and then decide the future of the company, etc., etc., etc. But your ownership is restricted to this. So, doesn't mean that I am not a owner of the enterprise. You are an owner, but ownership is restricted to this. That is what is an equity shareholder. So, what happens? As a owner of the enterprise, I am entitled to all the profits or the loss of the enterprise. I am entitled to all the profits or the loss of the enterprise divided in the same proportion. Proportion of my holding, divided in the same proportion of my holding. That is all. Your holding is what? 0.001 percentage. Yes, you are eligible for 0.001 percentage of the profit or the loss. That is all. Now, next. So, if I am basically owning what do you call it as some shares, and I'm eligible for the profits, I am eligible for the losses, and so on and so forth, and perfect all these things out there, then is my, for example, in the same example of whatever in this Excel sheet out here, whatever we did, supposing the loss is more than 48,000. Supposing the loss is more than 48,000, in this case the loss, supposing it is more than 48,000, it is not for 10,854, it is what do you call it as more than 48,000 out there, it is, let us say it is something like, it is 54,000. Then do the partners have to bring in more money into the business out there as an equity provider? No. your loss is limited in the your loss is basically limited to the extent of your investment. That is, your loss is limited to the extent of your investment. That is, what do you mean by this? Let me explain. Supposing instead of the 10,854, the loss was 54,000. If the loss was 54,000, sorry, I think I should have put a negative sign there. Okay. If the loss was 54,000 out, then what is happening? If I sell all the assets, I will still not be able to pay off the liabilities. So what happens? The partners, whatever they have contributed, the equity contributors, whatever they contribute, they have lost the money. The other liabilities which are here, some of them will also have to bear the, basically will also have to lose the money in the process out there. They may not get the due what they have to get from the company. They may also end up losing some money in the process out there. That can also happen. That is, if the loss is higher than the capital. That is, here what we say, when this net worth becomes negative, we say net worth is eroded. Net worth is eroded. That means the company's capital has been completely destroyed. Net worth is eroded. The company's capital has been completely destroyed, and the loss is being borne by some of the, basically, unfortunately, creditors are basically bearing some of the there are creditors' claims. The claims from the creditors are not completely settled in the process, cannot be settled. Sir, would they not file a case against the partner? No. They, to whom have they lent? Have they lent to the individual or have they lent to the company? They have lent to the company. The company's duty to settle. The company does not have the money to settle. Over. Your job is, you have contributed as capital to the company. You are not getting that capital back. Over. Job done. Ends out there. That is the advantage of an equity. So, your liability gets basically, or your loss gets limited to the extent of your investment out there. So, having discussed all these kind of things and then talked about profit and loss borne by partners and so on and so forth, let us move to the next stage out there. How did the Lone Pine Cafe make this loss of 10,854? That is what is more interesting. So, we are looking at how was this loss arrived at? What did the company do to make this loss? What was their revenue? What was their kind of expenditure? We need to look at it. So, what do? We look at the next statement called, what is called as the income and expenditure statement out there, or profit and loss statement, whichever way you will call it out there. Income and expenditure statement. We are looking at, let me look at the income and expenditure statement out there. Let me basically look at what do you call it as the income and expenditure statement out there. I am just going to prepare what do you call it as the income and expenditure statement in this particular case. I am just going to just cut and paste this so that easier for us to. Okay. The next statement, as I said, is income and expenditure statement, or what do you call it as profit and loss statement. Income and expenditure statement for the period November 2nd to March 30, whatever is the year, we can just mention the year in this particular case, whatever, November 2nd to March 30 out. Now, that is for, unlike a balance sheet was always on a specified date. Income and expenditure for a specified time period, we have prepared it for a time period out. Now, with regard to that, I have uploaded what is called as Lone Pine Cafe B out there along with as a PDF material. And please note, all these cases are from the prescribed textbook that I have indicated. The prescribed, one of the prescribed textbook, the first in fact prescribed textbook, all these cases are there. If you look at chapter 2, you will find Lone Pine Cafe A. If you look at chapter 3, you will find Lone Pine Cafe B. So, I am just taking the one from the exercise textbook exercise and trying to solve it. I am not bringing in material outside of the text that I have prescribed out there. Okay. Now, let us come to it. If I read the loan point cafe B, it says that in addition to preparing the balance sheet, that is a continuation of what do you call it as loan point cafe A is what we are going to discuss now. In addition to preparing the balance sheet described in loan point cafe A, Mr. Simpson, the accountant, agreed to prepare an income statement. He said that such a financial statement would show Mrs. Antonio how profitable operations had been and thus help her to judge whether it was worthwhile to continue operating the restaurant. In addition to the information given in loan point cafe A, that is, I repeat, in addition to the information given in loan point cafe A, Mr. Simpson learned that the cash received from customers through March 30th, that means till March 30th, amounted to 43,480 and cash payments were as follows. So, what happens? Cash received from customer, obviously you have not received advance. If you have received advance, what will happen? On 30th of March, you would have seen a liability because advance received from customer saying out there. There is nothing out here. That means all the cash that you have received are from customers and none of it is an advance. It is basically a sale that has taken place and you have received it. So, what happens? Is it an income? Is it a revenue? Well, yes, it is an income, it is a revenue for you. I will say cash received from customers, cash received from customers out there. In this particular case, I am just going to do this, and then what is the amount of cash received from customers? That is about 43,480. Now, is my income only 43,480? Is my income only 43,480? No. Why? Because income and expenditure statement, what we do, we follow what is called as accrual concept out there. I am sorry, I did make a mistake, spelling mistake in the first class when I wrote the word accrual. So, ACC. Am I right with the spelling today? Yes, accrual concept. Now, what is this accrual? Let me repeat again. We are looking at any income, revenue or expenditure that has occurred during the specified period. We are not worried about cash inflow or outflow. No, we are not worried about that. We are worried about revenue and expenditure. That is, am I eligible to get? Has the ownership transferred? Have I enjoyed the benefits? Now, what do you mean by that? For example, any aspect becomes an expenditure if I have enjoyed the benefits of it and I am liable to pay. If I have enjoyed the benefits of it between November 2nd and 30th of March and I become liable to pay, then it is an expenditure. For example, anything becomes an income if somebody has enjoyed the benefits what I offer. For example, in this particular case, I offer food in the cafe, somebody has enjoyed the benefits of the cafe and they owe me some money, it is considered as a revenue which is accrued. You might not have received cash, but it is a revenue which is accrued during the period November 2nd and March 30th. So, in this going by the same lines, if you look at in this particular case, you see this, there is ski instructors who have run up accounts to the extent of about $870 as in the balance sheet on 30th of March. Have you received it? No, you have not received it on 30th of March or before 30th of March. But Are you eligible to receive it? Yes, you are eligible to receive it because the ski instructors have used the facilities of the cafe and they owe the cafe $870. So, it is a revenue that is accrued during the period out there. That is what I will say, revenue from what you call it as credit sales to ski instructors. Credit sales to what is called as ski instructors, how much is it? $870. So, what is my total revenue? My total revenue is these two put together. Now, again your question might be, sir, what happens if I do not receive the money? If you do not receive the money, the day on which you get to know that you will not receive the money, we will handle it at that point of time. But as of today, they have come and utilized the facilities of all your cafe, they owe you the money, you can catch hold of them and collect the money, well, it is an income which is accrued. Profit and loss statement or income and expenditure statement, as always, as I had indicated in the last class or in the first class out there, it is always on what do you call it as an accrual basis out there. It is not necessarily on a cash basis. We are not worried about cash coming in and cash going out. I use multiple examples for it. For example, let me go back and then use an example out here. I'm sorry, I think, yeah. Let me go back and use an example out here. Supposing I say that, let us say today is 11th of January. I make a sale for $50,000 on 30-day credit. The fellow buys $50,000 worth of goods from me today, keeps it in his godown, keeps it in his stockyard of the purchaser, and next day it gets destroyed by fire. As far as I am concerned, I am eligible to get this $50,000 from this guy, from the fellow to whom I have sold, because ownership has transferred, the loss is his problem. For me, the income has accrued. Sir, he will not pay. When he will not pay, I have a legal course ready to sort of take care of it. That is a different ball game altogether. But as far as I am concerned, sale has taken place. The goods have moved out of my stockyard. The good is in his stockyard. In his stockyard, there was a fire. In his stockyard, there is a loss. So, who owns the goods when it was destroyed? The guy who bought it from me owns it. So, he owes the money. We cannot say the stock is destroyed by fire, he will not pay, that is a different ball game. But he owes the money, that money is revenue for me has occurred the minute the ownership transfers, the minute it leaves my shop floor. The minute it leaves my shop floor or the minute it leaves my stockyard or whatever it is, stockyard, whatever it is you would say, the revenue has occurred because ownership has transferred in this particular case. So, same way if you sort of take it forward and then look at it in this Excel sheet out here. This $870 worth of food has been consumed or the facilities of the cafe has been consumed by the ski instructor. So, instructors owe me the money. So, naturally it is an income which has accrued. So, what is your total income? Total income is whatever cash I have received from customer. Sir, you might have received advance. Yes, I might have received advance, but if I have received advance, my closing balance sheet should show the advance that I have received as a liability, because I have received an advance, I have not performed the job for him. So, and in the event of the cafe's closure, I have to pay him the money back. Obviously, what? It is a liability and you do not see any liability. So, I presume therefore, since I do not see any liability, I see all this cash received from customers or for the services that they have enjoyed from the cafe during the period November 2nd to March 30th and they have paid for it. And this is the credit customer. So, my revenue is both put together. I hope I am clear with this.